$300 trillion. It's a number so vast, it loses all meaning. It is more than 3 times the value of everything produced on the entire planet in a year. If you were to count it, $1 per second, it would take you nearly 10 million years. This isn't just a number. It's a claim on future human effort. It's a promise to pay, layered on top of another promise to pay, creating a global architecture of obligation that touches every single person. The immediate question is always, how will we ever pay this back? But that is the wrong question. The correct and far more revealing question is this. If the world as a whole owes $300 trillion, who precisely is the creditor? Who is on the other side of the largest balance sheet in human history, waiting to be paid? The answer is not a simple name or a single entity, and uncovering it reveals the fundamental mechanics of our modern financial world.
To locate the creditor, we first must dissect the debt. This $300 trillion figure is not a single loan. It is broadly composed of 3 distinct sectors. First, there is government or public debt. These are the bonds and treasuries issued by nations to fund their spending, from infrastructure to social programs. This is the portion we hear about most often, like the $34 trillion U.S. national debt. Second, there is corporate debt. This is money borrowed by companies, large and small, to finance operations, expansion, and research. They issue bonds and take out massive loans to fuel growth. Finally, and perhaps most importantly, there is household debt. This is your mortgage, your car loan, your student debt, your credit card balance. It is the collective borrowing of billions of individuals. These are not just abstract figures. They are legally binding contracts, financial instruments that are packaged, sliced, and sold on a global market, each one a promise of future payment from a specific source.
So, who holds these contracts? The first layer of creditors is deceptively simple: large financial institutions. When a government issues a bond, a commercial bank or a large investment firm often buys it. When you get a mortgage, your bank is the initial creditor. These institutions are the primary market makers. More importantly, our collective savings are managed by them. Pension funds, for example, are colossal creditors. They take contributions from millions of workers and invest that capital to generate returns for future retirees. A significant portion of those investments is in government and corporate bonds, making every future pensioner a de facto lender. Similarly, insurance companies take our premiums and invest them to ensure they can cover future claims. They, too, are among the largest holders of debt in the world. So at a surface level, we owe the debt to the banks, the pension funds, and the insurance giants. But this is only a partial truth. It answers what, but not whose. Whose money are they actually lending?
This is where the story shifts from simple accounting to the core of the monetary system. The debt has grown to a size that is mathematically impossible to fund from savings alone. This expansion is enabled by the actions of central banks, like the U.S. Federal Reserve. Through a process known as quantitative easing, a central bank can create new money, not by literally printing it, but by electronically creating central bank reserves. With these newly created reserves, it buys assets, primarily government bonds, from the commercial banks. This does 2 things. It injects massive liquidity into the banking system, and it keeps interest rates artificially low. This encourages more borrowing as debt becomes cheap. This is the great illusion. It feels like lending, but it is fundamentally credit creation. The money isn't from a saver's deposit, it's new currency created with a keyboard, backed by nothing tangible, only by a promise of the government's future ability to tax its citizens. This mechanism allows the debt to expand far beyond the limits of real-world production and savings.
Now we arrive at the ultimate truth, the core of the paradox. We asked who the creditor is. The answer is hiding in plain sight. It is us. You are the creditor. I am the creditor. The people are the creditors. It is our labor, our production, and our savings that give the entire system its value. The money in your bank account is technically a loan to your bank. Your pension contribution is a loan to the fund. When you pay an insurance premium, you are funding their investments. The financial system is a complex network of intermediaries designed to channel the stored economic energy of the populace, our savings, and lend it out. But here is the cruel irony, the scam at the heart of the system. We are also the ultimate debtors. We owe the government debt through our future tax obligations. We are diluted by inflation when central banks create money to service that debt, making our savings worth less. We are both the source of the capital and the ones who must labor to pay it back. We are lending to ourselves, but the intermediaries and primary borrowers extract a significant portion of the value in between.
But what about foreign creditors? We constantly hear that countries like China and Japan are the biggest lenders to the United States. This is true, but it's a consequence of a larger global game. Since 1971, the US dollar has been the world's reserve currency. This means international trade, especially in critical commodities like oil, is priced and settled in dollars. Therefore, every country needs to hold a large reserve of dollars. The most convenient way to hold and earn interest on these dollars is by purchasing US Treasury bonds. In effect, nations like China sell us goods, receive dollars, and then lend those same dollars back to the US government. It's the largest vendor financing scheme in history. It ensures a constant demand for US debt and allows the US to import more than it exports. However, this system is now showing signs of fracture. Geopolitical rivals are actively seeking alternatives, settling trade in their own currencies, and, most notably, accumulating massive physical gold reserves as an alternative to holding dollar-denominated debt.
This brings us to the endgame. A debt of this magnitude, growing exponentially, can never be repaid in currency of equivalent value. It was never designed to be. The system does not require repayment. It requires perpetual servicing. The interest must always be paid. The only ways out of such a mathematical certainty are ugly. One is a mass default, a cascade of broken promises that would vaporize wealth and collapse the global economy. The other, far more common historically, is inflation. The debt is paid back, but with currency that is worth substantially less than when it was borrowed. This is a default in slow motion, a silent theft of purchasing power from savers and wage earners. The scam is that the system is engineered to transfer wealth. It moves value from those who save and labor in the currency to those who own hard assets and are closest to the credit creation. This is why, in an era of unprecedented debt, the price of gold, an asset with no counterparty risk and thousands of years of history as real money, is reasserting itself. It is a flight to safety from a system whose very foundation is an unpayable promise.